The presidential election is behind us, but there's another political cliffhanger, the fiscal cliff. That's shorthand for a double whammy of nearly $670 billion worth of tax hikes and spending cuts that are scheduled to kick in January 1st and could plunge the economy into recession if Congress doesn't act by the end of the year. Not only does the fiscal cliff pose a threat to the U.S. economy, the G20 warned that the U.S. fiscal cliff is the #1 risk to the global economy. Therefore, how the cliff is addressed is critical. First, it's worth reviewing how the fiscal cliff came to be and what it exactly includes. This man-made economic threat is the result of a deal Congress struck in August 2011 to raise the government's borrowing limit. In return for raising the amount America can borrow, lawmakers passed a law that would enact automatic spending cuts across defense and non-defense government programs. That was supposed to force Congress to compromise on a serious plan to cut the nation's debt before letting major spending cuts go into effect. And, well, here we are. The long list of tax hikes and spending cuts set to go into effect includes the expiration of the Bush tax cuts that were put in place in 2001 and 2003 and were extended in 2010. The expiration of the alternative minimum tax patch, needed because it's not indexed for inflation. Lapse of the payroll tax cut, expiration of unemployment benefits, new taxes from the new health care law, expiration of a handful of friendly tax provisions or tax extenders, and spending cuts in defense and non-defense spending. So what are the odds Congress strikes a deal before year end? What does a potential deal look like? And what does it mean for the economy, the markets, and your bottom line? Here to weigh in is Todd Schoenberger, Managing Principal for the Black Bay Group. Todd, welcome back.
Thank you.
It's so great to have you in studio.
Thank you for having me.
So here we are, a year after all this campaigning.
Right.
Presidential election is behind us, but we're still staring at the same gridlock Washington. Same president, same composition of Congress.
Yep.
Does a deal get done, or do we go over the cliff?
We go over the cliff, and there's not a lazy river at the bottom either. It's going to be devastating for the U.S. economy, especially for Americans, because of those extra taxes that you mentioned. You're not only looking at that, you're looking at how it's going to impact our national security. $55 billion, 9% of the entire defense budget is going to be wiped out. And with so much that's going on, geopolitical risk that's taken place, that's one area that we do not want to cut. And then you add in everything else with just the ancillary items of how poor the economy is. And we're already we're on toothpicks right now, Jennifer, as
So do you
know.
think the U.S. economy goes back into recession next year?
No doubt. Look, you go back to World War II. Anytime the year-over-year GDP rate dips below 2%, the United States economy has always ended up in a recession. Typically takes 2 to 3 quarters after that impact, but we always end up in a recession. First 9 months of last year, we were below 2% in that year-over-year rate. Here's the problem. The Fed has actually helped us. Federal Reserve has actually kept the U.S. economy from falling into another recession. The problem is that the Fed isn't there to bail us out. This is an item that everybody talks about, kicking the can down the road, and eventually you hit a brick wall. Well, guess what? This is the brick wall. It just so happens to be a cliff.
Todd, what are the chances we get a grand bargain in 2013, that compromise where we're actually attacking the long-term debt problems of this country? If you and I are talking next year this time, is there a grand bargain?
No way. The President of the United States he has expanded the federal government balance sheet so much. I mean, you're looking at $16 trillion in already existing debt right now. That's going to have to be expanded, because here's the problem. We're talking about going over the cliff, falling into a recession. Even if we don't go over the cliff, if there is a deal that's in place, you still have a very, very fragile economy with the Fed that's even helping to keep things from falling even further lower. Here's the problem. The Fed, they can't really do very much now to bail us out. So now going forward, what happens to us now? You have to suspect that the government's going to have to continue to expand. Remember, 20% of GDP is government spending. So if you're not picking up the area elsewhere, government spending has to keep increasing.
Where do you see the biggest sticking point between Republicans and Democrats? It would seem to me the most contentious area is whether the Bush tax cuts could expire for those that are earning more than $250,000 per year.
I don't believe so. I mean, because, and here's why. You remember, American voters knew that going into the election, so they knew that that was going to be the threshold, and Americans are willing to accept that, obviously, because they voted and re-elected President Obama. So I would think that there will be some congressional, or how should I say it, influence from from constituents saying, look, get something done. We're willing to accept this as being the threshold. I think the issue is going to be the short-term impact, such as that payroll tax cut, or hike, I should say, and then you're looking at extended unemployment benefits for those out of work 27 weeks or more. You take that away. That, I think, is going to be the real sticky point. And as odd as it sounds, that's where Republicans are going to say, boy, we can't do this to Americans. And it's almost a twisted way of looking at it. It's more of the Democratic way. But John Boehner has said, there's such a focus on the rich right now, why not look at maybe the lower and middle class?
What about the alternative minimum tax then? Is there the patch get extended?
I mean, look at $3,700 tax increase for what, 24 million Americans with the AMT going. I would have to say, where are the cuts? You have to negotiate somewhere. I would think that that's probably one area that will probably be negotiated out, only because you can use that as a little bit of leverage, because you can always revisit it down the road later on, and it's not going to impact Americans immediately. What's going to impact Americans is in January, when they immediately see that in their paycheck, that, oh boy, their take-home pay is less.
What about investors? I think the most pressing question for investors regarding the fiscal cliff is whether there's going to be a tax hike on dividends and capital gains. Do you see the tax rates going higher?
It's huge, because you're looking at right now a dividend tax rate of 15%. For some people, it's going up to 43%. For those on a fixed income that depend on that dividend income, they're going to be hit with extra taxes. That is a big one. I question why some companies right now, S&P 500 companies, would increase their dividends, because it almost is dividend-paying stocks are going to be out of favor, and therefore it's going to hurt shareholder value down the road. It's almost like a company's just better off just keeping it on the books, whether they're earning any money or not.
So what's the actionable advice here for investors? You know, what do you do? Do you, in anticipation of a tax hike on dividends, on capital gains, do you take some of your profits here if you have a company that's run? Do you avoid dividend-paying stocks? Is that really a way to invest?
Okay, here's what I'm going to say, and this is somebody that's in the business, would love to see trading volumes go higher, but if I'm an investor, Main Street investor, I have to stay on the sidelines right now until this mess gets figured out, because here's why. The immediate reaction after the election, Wall Street sells off. And the reason why it was selling off is because we had the same, like you said, same composition before, pre-election. Now you have it post-election. Traders on Wall Street are saying, look, if nothing got done pre-election, what makes you think it's going to be done post-election? And we all don't, nobody is confident that that's going to happen. So therefore, stocks are selling off. It's definitely not a place to be right now, because even if a deal is in place, we still don't know what is being cut, what's going to happen as far as tax hikes. So you want to stay away, stay on the sidelines if you can, because the risk is just too great right now.
All right, Todd, sobering conversation. Thanks so much for your insight.
Thank you, Jennifer.
Todd Schoenberger, Managing Principal of the Black Big Group.